All right. Welcome to the podcast, the Multifamily Investor Nation podcast. Looking forward to the episode today. We're going to be talking with the Trident Multifamily Group with Mike Vann, Carl Suverkrop, Rodney Miller. So looking forward to this episode today. Welcome, guys.
Thanks for having me here.
Well, this is going to be a little bit different. So lately we've had a couple of groups that have wanted to kind of do these podcasts together to kind of have the team there to kind of, fill in certain gaps that might not be able to be filled in by just one person. So it's great to have all three of you here. We're going to get a lot of good, deep information on this portfolio acquisition that you had that was out of Tulsa, Oklahoma. It was 174 units. You closed it in November 25th, 2019. It was a two portfolio property, 102 units in one and 72 units in the other, called Stratford and Brownstone out of Tulsa, Oklahoma. So I wanted you to get us started first before we dive into this property and just take, a minute or two and, kind of go around, have Carl start, then Mike, and then Rodney, and just kind of share with us a little bit about your background and where you are right now in the multifamily space.
Okay, thanks, Dan. Yeah, originally from South Africa, officially immigrated here in 2015, and had sold off a security business in South Africa, and wanted to get going in real estate over here. I was very fortunate in that my wife has been in the apartment industry for near on 20 years. So spending time with her really got me into understanding the operations and from a business point of view, understanding the business of apartments. So that is what I've been working towards. And then Mike, Rodney, and I met up a couple of years back and decided to start pursuing syndication together. And closed on our first deal together earlier this year. I personally had done a few passive deals as a limited partner in 2018. Then we closed on a deal in early 2019, and now this is our second acquisition. So that's where I'm at.
Yeah. So I have been investing in real estate for close to 20 years now. In my own portfolio for up until the last 2 years, had never had any partners, had just done solo acquisitions and slowly built up over time. Started off with, like a lot of people do, with single family, small multifamily, and traded up into some smaller apartments, and then sold my very first acquisition in 2017 and bought a 55 unit apartment complex of my own, and did a deep value add on that. It was a pretty distressed property, and got that up and going. After deciding to hit my 5-year plan of retiring from corporate, that I needed to scale a little faster, and so joined a mentoring program. Met Carl and Rodney a couple of years ago. Was in a few other partnership groups, and when I met them, decided we would pursue stuff together. Did our first acquisition earlier this year. That went so well, we had great synergy. Decided to form Trident Multifamily and pursue deals only with each other going forward and build a company. And so we acquired our second Trident Multifamily property this past November. Well, just a few weeks ago.
And I've been self-employed since about 27 years old. I own medical practices like you, Dan, and got into it at an early age. But around 40, I realized I didn't have much of a retirement. Started freaking out a little bit and started trying to figure out how I was going to someday be able to retire. And I don't even know what that means because I'll never really retire. But decided single family homes was the way to go. I became a home investor franchisee here in Oklahoma. I'm in Oklahoma City, by the way, and started buying single family houses. Started that way, like a lot of folks do. I owned about a little over 100 houses, and then decided I'm a slow learner. A few years ago, that I needed to go bigger, faster. So started looking into multifamily, and started going to conferences and kind of just learning about it. I spent a couple of years just learning before I did anything, and met these guys, and the rest is history. We had an alignment of interest, decided that we would work together to take down some properties, and our first deal went so smooth. we decided to form Trident and took down this 174 unit property, and we're looking for our next deal. Carl and I are heading up to Wichita, Kansas tomorrow to go look at another property, and yeah, things just been going really good. We really enjoy it. It's everything I thought it would be, and it's just a lot of fun. We enjoy developing these deals, improving them, and giving our investors a great return. It's a fun business.
So one of the things I'm curious about, because there's obviously three of you, and my group, passiveinvesting.com, we have three people in our group as far as partnerships, and kind of have our own different roles and responsibilities. We kind of stay in certain lanes. Does your group have that as well? Or do you guys kind of like help each other out in different areas, or is there like really defined roles and responsibilities that each partner has?
Well, we do have certain strengths that we play to. Of course, we bounce ideas off of each other, even within those our own lanes, so to speak. But yes, we do have specialty areas, so to speak. Carl's more the numbers guy. I have my family had a construction business growing up, so I have that background as far as CapEx and things of that nature. And Rodney does a lot with our investors and the legal side.
That's pretty cool, because there's a lot. That sounds like it's very similar to our setup, because I'm primarily investor relations and marketing and overall strategic objectives, piece of the business. And then we have Danny Rendazza, who is all of our numbers and financial underwriting and due diligence and stuff. And then we have Brandon Abbott, who is more of our construction lead and does a lot of the acquisitions and things. But you're right, Mike, that a lot of these roles are kind of intertwined. So you definitely have lanes you got to stay in, but at the same time, they're all interweaving. And so there's definitely some interplay within each one of them. And it's important to know what everybody else in the partnership is doing, so the decisions that you make in your particular role, how it affects the other positions as well.
Absolutely. And we're taking it to the next level here pretty soon. We're going to go off site and do some really big management building and really like set our strategy, and put all that into place, and really, because this is a business. We're just looking to scale, leverage, and do it responsibly, and make sure that we do it the right way. So our next step is to really focus on our management group, and that'll take a few days, every quarter, to keep realigning ourselves with our goals and where we want to take this company.
Well, I will agree with you that this is a business. And I think a lot of times we see people that are getting into this and think of it more as a hobby or some sort of game that they're playing. And it truly needs to be treated as a business when you're bringing on investor funds and you have that big responsibility of making sure that investment goes well. It needs to be treated as a business. And I'm actually in the process right now of writing a book about it actually being a business. I don't think that there's anything easy about what we do. There's a lot of different pieces and moving parts, and one thing can go wrong. It can cause a lot of different issues. And so to be able to play the game, if you want to call it a game that way, as a business, I think is the right way to do it. So let's dive in.
I'm sorry, I didn't mean to cut you off. Go ahead.
Yep. Okay. I was gonna say, let's dive in right now to this particular acquisition, which is that 174 units out of Tulsa, Oklahoma. Like we said earlier, it's a two property portfolio, 102 units in one and 72 units in the other. And so I'm going to pose some questions to you as we're going throughout, and one of you three can jump in as you guys see fit. But I want to first talk about how you actually found this particular asset.
Carl?
So I found it. I'm as we said, numbers, and I like to say the gopher. So, nothing can replace just reaching out to brokers. And we set quite a high activity rate for reaching out to new brokers about a year ago. And this deal came across. It was marketed, but it was marketed by an out-of-state broker. So, at the point when we first identified and engaged on the property, we had just had an LOI accepted on our first property. So we kind of gave them the thanks, but no thanks. And the LOI that we had accepted was in the Tulsa MSA as well. So, I don't think they got much feedback from their marketing efforts. And they came back to us knowing that we had, once we had run the course with the other deal, came back to us and said, well, this is still available. We've got updated numbers. The seller was self-managing. So that was also part of the issue, is that the accounts were owner managed or self-managed. So a lot of spreadsheets and I've still got probably 3 inches of utility bills stacked up on the desk behind me. So a lot of manual work went into it. But yeah, it was, I want to say, on market, and just got in touch with the deal through reaching out to brokers and letting them know what we're up to.
And I think that one of the things that can be a kind of a value play in these types of assets is the fact that, as you probably noticed, not a lot of people were bidding on that property or wanting that property because it was self-managed. And, I've looked at some deals before where they were self-managed, and we've decided not to move forward because it is an uphill battle to try to pull information out of some of these property owners that aren't usually managing their books properly. But it can also be kind of a diamond in the rough if you can kind of get a good price on that particular acquisition as well.
Absolutely. And that is what it took. From day one, we evaluated what variables and what risks were in it for us. And that's kind of where we shot them a number, and we said, this is where we would be buyers. And it kind of went back and forth for a long time. And as we extracted more and more information, a lot of it manually and on site, we kind of built up to the point where we're able to get the deal done.
Now, do you have other assets in this market that made you more confident about it?
We do. It's in the Tulsa MSA. So it's a city outside of Tulsa City called Pryor, Oklahoma. But we've been doing extensive work in the city, Tulsa itself. A lot of networking with brokers and looked at a lot of deals. So the real eye-catching thing with this deal, which I'll say is what really was the diamond in the rough moment, was looking at utility expenses. Just had a look at the entire deal, and we identified that the utility expenses were about 40%, 40 to 45% higher than the norm. Just the plain average of where our utility expenses are in that market, they were high. So we thought, let's investigate and see, is it just the way the property is, or what is that opportunity? And on one of our tours, we walked in to a vacant unit that looked like it had been vacant for a good long while. And the hot water faucet in the bathroom was running full blast. The entire countertop was warm. That's how long this unit looked. Wow. I don't even know how long it had been vacant, but it's like, well, if that's, and the manager was with us, showing us the property, and she really wasn't bothered about the hot water just literally gushing out of the faucet. And we thought, wow, okay, we're starting to see that maybe even this utility conservation might be easier than we were expecting. So just identifying the opportunity and then going and confirming the opportunity is what we spend a lot of time doing on this deal.
Hey guys, there's some kind of weird drilling going outside my office, so I'm just going to turn my microphone off and I'll pipe in when they stop drilling.
I said, I think you have a really good microphone because I don't hear it. So that's actually good.
Yeah.
You can't hear that?
No.
Oh, that's amazing. Okay.
I'm telling you, these microphones are great.
No, that's crazy. Yeah. It's loud.
Yeah. So let's dive into the part of hard money or non-refundable hard money. And for those of you who are listening, when we talk about hard money, we're not talking about hard money loans or anything. We're talking about earnest money that is being put up that could go hard or non-refundable day one or after due diligence. I'm assuming that because of some of the issues with this particular property and it being self-managed, that probably wasn't a requirement. Is that correct?
Correct. Yeah. In this market specifically, there's not a lot of hard money being placed immediately. we did make our earnest money non-refundable after due diligence. And that due diligence period did not start until we had our required list of documents. So we gave ourselves and structured the contract accordingly to give ourselves plenty of room, plenty of runway to make sure that we had all the adequate information we needed to make that decision before the due diligence period was completed.
And at what point during the entire process did you guys end up touring the property? Because I know you guys obviously submitted that LOI earlier on. I'm assuming you probably toured it then. So when it came back around, did you guys do another tour, or were you guys pretty confident with it at that point already?
Yeah, I think we toured it probably 3 times before we actually executed a PSA and did our due diligence. One was very early on, and then second time went around with our management company just to get their opinion and their feel on it. So we'd spent a reasonable amount of time on the property and engaged on the property. As I say, we kind of had to build up a lot of utility bills, expenses, and just check for consistencies in the financials. So yeah.
Well, and one thing I want to point out here, which is important as well, is whenever you have earnest money like that you're going to say that is going to be going hard or being non-refundable after a certain period, like that due diligence period, which is fairly common. You want to make sure, just like Carl said, that you have inside of the PSA, inside of that contract, that purchase and sale agreement, that due diligence period does not start until you have certain documents. And usually you'll want to list out the documents that you want to have up front, so that the moment you get those documents, that's when the clock starts for you to have that entire time to be able to review all those documents. Otherwise, they can give it to you on the last day, or maybe not even give you some stuff at all. But once that period expires, it's non-refundable.
I think our due diligence period kind of went up to the day we closed because the guys were so slow in getting the documents to us. It dragged on forever. So we were like, we'll ride this out and let it go on. We were still performing our due diligence stuff, but yeah, that worked to our advantage quite a bit.
We kept the deal moving on our side as we were extracting documents week by week. And so finally, by the time, like Rodney said, by the time we finished our due diligence document list, we closed within a couple weeks after that.
What was the occupancy of this property when you acquired it?
It's right around 85% occupied. So that was because there's 2 properties that they've kind of teeter-totted. One was down at 80% and one was at 88, and now it's kind of flip-flopped, and one's at sort of 83 and the other's at 90. Being the smaller properties at 90. So it's kind of flip-flop, but we've settled at about 85.
And do you attribute a lot of that flip-flopping and fluctuations like that due to the poor management?
Yeah, absolutely. And that was another thing we noted. We always knew that it was mid-80s occupied, and in the submarket, it's a well-occupied, 90, mid-90s in the submarket. So our question was, why is this one underperforming? And again, when we toured the property on one of the occasions, there was not one unit ready and available. And I think at that stage, there was at least 20 units down, not down, just 20 units not ready. And we said to the 2 managers, if we arrived today and needed to lease an apartment, do you have one for us? And they confidently said no.
What's really interesting. Oh,
yeah.
Sorry, Carl. This owner had a master lease with an oil company. And so he had this place full for a couple of years with a large oil company. He didn't have to work hard. I mean, he got one big check. They put all their employees there. And I don't think he ever really, after they pulled everybody out of there, I just don't think he was really motivated. He was doing storage units and other things. And so I think that just became kind of a pain in the rear end for him after that fact. He wasn't putting money into it. He wasn't really managing it well. Didn't seem to be getting a lot of his attention after that. So, every property has a story. That's kind of the story behind this property. It's just basically an uninterested owner that had it pretty good for a while and then lost that major contract and never really seemed to bring it back after that.
Was there on-site management on this one?
Yes.
Yep.
Yes,
There's
we had
Both of them?
a manager at each location
Mhm.
and 5 maintenance people. Matter of fact, one of the days we toured, and we asked about are all the vacant units not being ready. They had 5 people doing yard work and no one working on make readies.
5 maintenance people.
5.
Yeah.
Yeah.
Oh my goodness.
Yeah.
But you can understand 5 maintenance people if you had like 20 units and they were all being worked on, but to be out
Right.
in the yard, like playing
Yeah.
around in the grass, that doesn't
Right.
make any
Not
sense.
blowing grass and weed eating and stuff I mean, it was, yeah. And needless to say, their payroll was quite high as well, which we saw an opportunity there too.
Mm-hmm. What was the what's the unit mix?
So it's predominantly 1 bedrooms. So we're at about 45% 1 bedrooms, which is quite high. But the location really lends itself to, working professionals. Although the property is not a working professional property
Yes.
as it is, that is where we're going to be taking it. But predominantly 1 bedrooms, 2 beds and 2-bed townhomes, and then I think there's about 9% three bedrooms.
So what are kind of the different price ranges for these different units? So like the 1 bedrooms, the 2s, the 2 townhome, and then the 3s.
Yeah. So it is built in the 60s. So there's master metered. So we do an all-inclusive lease, which does include cable. So we steering away from the all bills paid term. But we're at a price point of around 800 for a 1 bedroom. The 2 beds are at around 900. And the 3 beds are right at 1,000, which we're going to start pushing to probably 1,050.
Okay. And are those the in-place rents, or those the ones like you're on your performer, you're going to try to get the units to?
Those are our performers.
Okay. All right. So those are what you're hoping to get it to. And are you going to be changing from an all-inclusive to include the utilities and the cable to kind of breaking that out, or are you going to still include that altogether?
We're gonna start off with it all included, and then see if the opportunity presents to implement RUBS. Within that market, there are a lot of residents, which we know is pretty common all over, getting nickel and dimed with just all the upcharges, which we're trying to offer an all-inclusive, which includes utilities, cable, and we're actually implementing valet trash as well, which we can accommodate all of those in our market rents and still meet our pro forma numbers.
Does the cable also include internet?
It does not.
Okay.
So we're exploring what revenue generation we could get out of that. Actually, just had a chat yesterday with a broker who's going to advise us on possible revenue share that we can have on internet.
Yeah, there's lots of different options when it comes to, whether it be a cable contract or cable, revenue shares and things like that, or maybe even using a service that you can actually come in and bolt on an internet package on top of your program and resell basically your internet service to your residents and as an option. So I wouldn't necessarily force it on them, but be able to have a pretty good utilization with that, with some of these other assets that people are using this on, I think can be a good position as well. Obviously it depends on the class of the asset and the tenants and how much they're utilizing that versus just streaming things off their cell phones and various things like that too.
Yeah.
What are some of the other amenities or things that you're planning on adding or kind of doing to kind of transition the community, not necessarily from the interiors and more from the exterior side?
So one of the things we're going to be doing that's really kind of cool is we're going to be implementing a smart laundry system where residents will be able to check from their smartphone when units are available, how much longer is on their cycle, so they don't know when to go down and change their laundry, or when a unit's available, they'll be able to pay from their smartphones. So that's one of the things we're really excited about as far as attracting a younger and more professional demographic. Other than that, we're going to be implementing complete exterior rehab, refacing the property. It's taking it away from that 60s look, putting hardy plank siding on, new paint, horizontal fencing, horizontal rails, putting cool deck on at both pools, and building outdoor lounge areas, outdoor lounge furniture, large pergola with grilling stations outside, implementing pet parks at both locations. And both of the properties face an interstate, and so at one property there's a large wall that is facing the interstate. We're going to have a big mural painted there, easy for me to say, right behind the pet park, so it'll be really visible, bright, vivid, something that's easy to see from the highway, and hopefully we'll bring in some traffic.
What's the current budget for the exterior upfits on the properties?
Well, our overall budget's around $2.25 million.
Okay.
It's broken down. How would you say, Carl? Percentage?
Yeah, we're about 750,000 on the exterior.
Pretty strong.
Yeah.
Yeah, I do like when you said changing the exterior of the building. 1960s is sometimes hard to play with, but to be able to go in there and reface the entire exterior, especially with hardy plank, I think it'll definitely make a nice upfit and uplift for that particular type of a community.
We've got that old German look. You seen those old German buildings with the all the ornate woodwork and
Oh yes.
So we're just kind of modernized a little bit, especially with the horizontal, with the railways that are really ornate, and we're going to just horizontal,
Yeah. No, I think that'll be great. That's a great choice there.
Up a little bit.
I bet Mike had something to do with those decisions.
Oh yeah.
His little background in construction there. I say little, but I'm sure he's got a lot more than just a little. He's got a few gray hairs there, so it's probably a little bit more than a little, but we won't dive deep there. So let's talk about the interiors. What are you doing to the interiors of these units to kind of transform them to kind of match the exterior that you're going to be doing on this particular community?
Well, as far as interiors go, really everything the resident is going to touch will look and feel new. We have solid flooring in most all the units. Where it is needed, we will replace the flooring, but for the most part, all the flooring is really solid to this point. So, two-tone paint, resurfaced counters, refaced cabinets. Really, the vendor we're using they have their own cabinet shop, and we're really able to do some cool stuff with cabinet door fronts that actually have a textured look to them. It's a real modern look. So refacing the cabinets, like I said, resurfacing all the countertops, new plumbing and lighting fixtures, new low flow, toilets and shower heads. Actually they're doing a sweep right off the bat of all the units, putting in, changing out the toilets and shower heads and aerators to start our immediate utility conservation right off the bat.
And make sure that the hot water is turned off.
Yes, absolutely.
Yeah, and we're also including black appliance package. So every unit will be updated with their appliances as well, just because that's what's supported in that little submarket, and these dated appliances just wouldn't lend to what the bigger picture is for the property.
Right.
Are you going from like coil to flat on the stove?
It's a complete mix. So yes, some of them are coil, some are even gas. At the one property, they've flip-flopped. But yeah, it's going to be solid plate stovetops and not coils.
Yeah, everything will be a uniform look. It'll be really nice. And the thing about it is we're going to be able to go into these units, make the upgrades we're making, provide, like I said, everything with a new look and feel to the resident, and our rents are going to still be at or below most all the comps in the submarket, which we toured 7 different comps in the immediate submarket, and every one of them have a dated look. So we're going to have basically a brand new unit interior, brand new look and feel exterior, with market rent or with rents at or below the competitive properties.
In our pro forma rent bumps, I don't know if we interest, it's $80 per unit is what we're going for.
Okay. It's $80 rent bumps. And the interior, just kind of doing some backwards math. I think you had mentioned, Mike, that you were doing about 2.25, took out the 750 for the exterior, so leaves us 1.5 divided by the 174 units, about $8,600 a door on the interior. Is that about right?
Mm-hmm.
Yep.
8620 is what I came up with there. Okay, cool. So one of the other things I wanted to dive in now is about the due diligence. So obviously had a little bit of a trouble getting some of the documentation and different things from the financial side. The financial due diligence is what we called. What about from the on-site due diligence? What kind of things maybe came up during that process?
Well, we had our property management company works well with us on our due diligence, and we obviously, it's funny, we've had people of different opinions, but we're a firm opinion you need to tour every unit on due diligence. We had a chat or a discussion the other week. Someone felt that you only needed to do about 20% to get a feel for the property, which is not the case. And
every single unit. That's correct.
Yeah. So
yeah, we got a great story about how that would have burned us on one of our deals. But.
One of our deals, we would be underwater right now, which yeah, we didn't do it. So nothing, I guess, more water and utility conservation came to light of just, running toilets. A few residents identified, which, would probably be residents who would want to keep close tabs on and decide whether they renew with us or whether we don't renew with them. Oklahoma is one of those great states where you can give a resident a non-renewal. So yeah, we just got a feel, and then also listen to a lot of residents about issues which may not have been forthcoming. It is a boiler and chiller system. So there were a handful of residents who let us know that, they're struggling with hot water, and, do we have anything in our budget to take care of, mechanicals, make sure they're getting their hot water, and just a little insight, on things like that. And really, it was an interesting due diligence in terms of the physical. There was no major surprises, but there was a lot of feedback from residents as to what would make their lives better and make the community better. So yeah, no real surprises. I'm just trying to think if
one of the biggest things I think. Sorry to interrupt. I was just going to say or add that one of the biggest things that it seemed to come out was just confirming and finding more opportunity for to increase income through different measures, whether it be utility or amenity additions, things of that nature. I mean, the pets, for example, I don't think that it was alarming the amount of pets that were there versus what kind of, other income was shown during our financial due diligence portion. So we feel that we'll be able to enforce those things and actually increase our other income significantly as well.
So let's shift here a little bit. Talked a lot about the property, what we're going to be doing with it, how we found it. Let's talk about the financing piece of it. So what did you guys do as far as the financing piece for this particular acquisition?
We've gone with the bridge. Given the occupancy, we just didn't feel comfortable that agency, we could get there. Just records weren't strong enough for agency, and the amount of CapEx we're doing. We wanted to maximize, proceeds for handling that. So we've gone with a 36-month bridge which also has two 12-month extensions. So it could potentially be a 60-month bridge debt.
What kind of interest did you get on that one?
We got 300 over the 30-day LIBOR, which when we closed, LIBOR was at 172. So our all-in rate is 472 for this initial 30-day period, and then we adjust. But we did also buy a rate cap, so we're protected from how high it could go. I think we're at 5 and an all-in rate of, I think it's a 525 for the first year, 550 for the second year, and 575 for year 3.
And it's amazing right now how cheap, this is now, we're talking December 2019. So a month after you closed on that, but it's amazing to me right now on the bridge debt, how cheap those rate caps are, because if you actually look at the 60-month future forward curve LIBOR, it stays below 2 almost the entire time. And so the risk of it actually going up and even touching some of those rates is very low right now, which is why those rate caps are really cheap right now as well. Now, were you able to negotiate a floor on LIBOR? Because I know obviously when we're buying rate caps, we're actually kind of negotiating, if you will, our ceiling as to how high we're willing to pay on the interest. When we're negotiating with debt, we're obviously looking for how low, because a lot of these lenders will say, all right, we're going to base it off of the floating LIBOR curve or the floating LIBOR, but if it goes below a certain amount, there's going to be what's called a floor on their end to protect their downside. Was there some form of a floor that you negotiated with them on that?
Yeah, they gave us a floor at closing.
Okay.
So we did get LIBOR of the day. So we're at, our floor all in will be 472, which is, again, for bridge debt. Can't really complain about
Sure.
472 rate.
What did you originally underwrite it at?
525.
Okay.
So
it's a nice extra bump in the cash.
Exactly. Yes.
Yeah. So typical 311, 172 on the floor on closing, 4.72. Probably would stay there for a while for sure. Maybe a little fluctuation here and there. What's the plan after that? Is the plan to refinance and be able to return money back to investors? And do your investors maintain their original equity position, or are you planning to just refinance it and get out all of your investors? Or number 3, I know I'm throwing a lot at you, but I know you already know the answer to this. Or are you planning to sell it whenever you get done, doing the renovations and the value add and being able to move into a different property?
Well, we have a couple different options. I mean, obviously, it depends on what is happening in the market at the time that we're willing and able to sell. But if we were to, our plan is to actually sell and exit at or during year 3. And but if we were to refinance, we would keep our investors in, do some capital return, keep our investors in. We feel that we want them to be able to share in the upside just as much as we are. We view our investors as investor partners, not just investors.
This is truly a business, like we talked about earlier on. And in this business that we're talking about, the apartment syndication business, our customers are the investors. And we have to make sure that as we set in place our investor relations piece, that we always keep them in mind. And so I think that's very good that you guys have done that. It's exactly what our group does as well. What are you guys doing when you exit? Are you guys going to try? Obviously, you can't guarantee a 1031, but is your plan to actually try to 1031 that into another asset, or will you just sell the asset and disperse and then have the capital gains upon sale?
We have had several investors who are looking for more long-term deals, so we may have a portion of those that we can 1031 into another asset.
Okay, good. So how did you structure the deal with investors?
Carl?
In terms of just the returns?
Yeah, so kind of give me a breakdown of equity splits and structures and the returns and stuff like that, just kind of a high-level overview.
So we have got a 6% pref to our investors, and then a 60-40 equity split. But what we've done is our cash flow is not being considered return of capital. It's being return on capital. So that equity split upon sale will only happen once they've received back at sale 100% of the initial investment. So because this is a big reposition deal, we wanted to make sure that investors have, one, at least made a 6% return on their money before any split takes place. So they will have a 6-pref, and then the cash flow will be enjoyed up until sale. And then at sale, they will receive 100% of their initial investment back. And then we do the equity split thereafter. So there's a lot of pressure on us to perform, else there's not going to be, our returns are really based on that back end equity. That's a
true alignment of interest, we feel.
Sure. So are you basically saying that there's no cash flow promote, it's only a 60-40 on the sale promote?
There is 60-40 on the cash flow as well after the 6-pref.
Okay. So while you're holding the asset, you'll do 6% upfront to the investors, and then the rest of it is split 60-40 with no pari passu?
Correct. And then at the end, full return of initial capital and the split thereafter.
Good. That's great. I like to be able to see that. So what about your fees? What's kind of your typical fee structure on these assets?
So this deal, given the amount of time, effort, resource we had put in, we put in 3 points on acquisition, 2% asset management, and 0 disposition, 0 refinance fees.
One thing I'm going to give you as a little bit of a tip. And so for the listeners who are listening, this will be something that we've done recently as well. And it, again, I keep on saying this is a business and we're trying to take care of our investors. And this is one of the ways that we started to align with our investors. We do, acquisition fee up front. It's hard to kind of say, it can't be performance based. Obviously you're already working all the way up until closing. That is performance, right? I know you guys worked on this one for a long time. I think 3% for this type of an acquisition, heavy lift, is right in line with what you guys are charging there. Ours is typically 2%, but we've charged, up to 3.5% if it's a heavy lift like that. So I agree with you on that. One of the things that we started to do with our asset management fee and then our disposition fee, we don't charge a refinance fee because it's a little bit harder on a performance basis on that to be able to calculate the way I'm going to tell you. But what we do with the asset management fee is that if we can't at least hit the preferred return, then we don't take the asset management fee. And the reason why we started to do that is because I've been personally inside of some syndications where we have not hit the preferred returns, but the sponsorship team was still taking the asset management fee. And to me, I feel like that's a misalignment of interest. I would rather, as a syndicator, want to make sure my investors were taken care of first. So we always make sure that the investors get their return first. And if there's anything over on top of that, then we'll provide that asset management fee. And then, and so it's kind of a performance based there as well. The second thing we do with the disposition fee, I know you guys aren't charging it, but you could charge it and do it similar to what we're doing. Obviously not on this one because it's, in the past, but moving forward, you can bake into it that 1% disposition fee or even 2%, wherever you want to fall in line. We typically do a 1%, but we base it off of the original projections, meaning if we project an original 16% IRR on our hold period, if we don't hit at least a 16%, then we are not taking that disposition fee. But if we can outperform the property, we'll take that disposition fee before the rest of the cash flows are split.
I like it.
Yeah. And that way it doesn't actually affect your numbers when you're trying to calculate your underwriting or anything like that. You don't even have to calculate it at all because it's all after your projections and you just put it into your operating agreement. That's how it's split.
I like it. Carl, you taking notes?
Good to know.
Yeah. It's a little bit of a tip there, but I like the whole structure. It's great. Very similar to what we're doing in our group as well. A couple of other questions is, how did you raise the capital for this acquisition, and also how much were you raising for this one as well?
This was a 506C. First time we've done one. Our first raise was a 506B. And so we decided to give this a shot. We had a large equity raiser that we brought into the deal, and kind of he had a group of investors that he had tapped to bring into this deal, which didn't quite play out. But we went the 506C route just for that reason, so we could advertise to his investors. And it was really interesting, just totally different. Do you do C's or B's? What do you do?
We primarily do B's. We've done one C in the past,
Okay.
and have not done it again. And I don't know if it wasn't necessarily because it was more challenging or harder. It's just we've done fairly well with a 506B structure and haven't really needed to go to a C. But I'm curious to know what your opinion was on the process between the C's.
It was interesting because we were able to advertise more. I don't know when we do it again if we'll go back and do the B again. Because the original reason we did the C didn't quite pan out.
Yeah.
But it's really painful when you're doing a C and then you have a handful of investors from your previous deals that are 506B qualified and you can't bring them into the deal. That hurts, when you're trying to raise. But our total raise was $2.5 million, and it went pretty smooth. We brought in some other equity raisers to help us raise some capital, and brought them in as GPs. And I think it took us about 3 weeks to raise $2.5 million. So, yeah, I don't know if we'll do that again, but we've done a C, we've done a B, and the next time we do a deal, we'll have to sit back and really think it through how we want to take the next one down. So,
I know we've talked a lot about your particular acquisition here. I'm running up against the clock here and have to jump on another podcast here, but I do want you guys to share with the audience a little bit about how they can reach out to you if they have some further questions about maybe this particular acquisition, or maybe they want to join you on one of your future opportunities.
They can visit our website at tridentmultifamily.com, tridentmultifamily.com, or they can send any of us an email. They can hit our general email box at info@tridentmultifamily.com, or any of the three of us, Mike, Rodney, or Carl with a C.
Mike, let's see if you can point to Trident. Can you point to your logo? Good job.
Yeah, the whole reverse imaging thing gets me every time.
Your logo reminds me of the Maserati logo.
It was a nice model.
Yeah. Well, great. Well, for those of you who are interested, go to tridentmultifamily.com, find some more information about Mike, Rodney, and Carl. Gentlemen, thank you so much for joining us here. I know you've provided a lot of good information to our audience, and looking forward to having you on and back again in 2020 as you continue to close more deals.
Awesome.
Great.
Thanks, man.
Thank you very much, Dan.
Thank you.